Today, rates can go up. Make sure you have buffers. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, glass half full low signalled a major shift in the bank's outlook for the cash rate at the RBA's annual address to the National Press Club in Sydney on Wednesday, striking an upbeat tone in the economy but downplaying local inflation risks, and to explain the central bank's rationale and its forecasts for the year ahead. In his subsequent remarks, he gave some financial advice, saying rates may well rise and households should have some buffers. Sound of door slamming shut after the horse has bolted, methinks. Interest rates could plausibly lift off later this year if the economy continues to outperform expectations, according to the Reserve Bank Governor. But he repudiated markets pricing 4 rate hikes in 2022. Faster progress towards full employment and inflation consistent with the target does bring forward the timing of the likely increase in interest rates, he said, a result which he added would be welcomed. It will depend on how the supply issues are resolved and the strength of the pickup in labour costs. If things go well and the economy performs stronger, there is clearly scenarios where we'd increase rates later this year, he said. Whether that happens or not, the RBA's long-held guidance that the record low 0.1% emergency level cash rate would remain on hold until 2024 is now dead, with the most likely time frame brought forward to early 2023. The RBA is now aligning itself with the consensus among economists for rate hikes in the second half of 2022 or early the following year, but is still at odds with markets, who are tipping a cash rate of 1% by the end of the year. In fact, on Tuesday, the Reserve Bank revealed its first monetary policy decision for 2022, a bit of a non-event actually, that it would maintain the cash rate at its current low of 0.1% and it would cease its bond purchasing program. And Lowe repeated the bank's previous stance that it would not increase the cash rate until inflation is sustainably within the 2 to 3% range. The RBA has updated its underlying inflation forecasts, projecting that it will reach 3.25% by mid-2022 before moderating to 2.75% in 2023 as supply pressures ease. Previously, the RBA had insisted it would be unlikely to raise the rate until its previously set forecast of 2024, as inflation wasn't expected to hit 2.5% until the end of 2023. But Dr. Lowe acknowledged that inflation had risen at a faster rate than previously expected, with underlying annual inflation in 2.1% and 2.7% in the September and December quarters, respectively. Based on the evidence we have, it is too early to conclude that inflation is sustainably in the target range, he said. In terms of underlying inflation, we've just reached the midpoint of the target range for the first time in over 7 years, and this comes on the back of very significant disruptions in supply chains and distributed networks, which could be expected to be resolved over the months ahead. And the RBA has also stated that in order for inflation to be sustainably within its target range, it will need annual wages growth to rise to at least 3%. While there has been a recent uptick in wages, Dr. Lowe reflected that there had only been a rebound to pre-pandemic levels. And just pause there, because effectively the RBA is now putting wages growth in the frame when it comes to lifting rates rather than inflation, which is an odd move, but could give them a bit more wiggle room. The RBA's central forecast now is that the wage price index will rise by 2.75% over 2022 before it rises by 3% in 2023. And just recall how accurate their forecasting of future wages growth has been over recent years. Not at all. Dr. Lowe nodded to other countries that had closely followed the end of their bond purchase programs with immediate cash rate rises, but insisted the same wouldn't apply to Australia. He believes Australia can take some time to obtain greater clarity, in contrast to other countries such as New Zealand and England, which have already moved to raise their cash rates. As he explained, countries with higher rates of inflation have less scope here. While inflation has picked up in Australia, it remains substantially lower than the 7% in the United States, the 5.4% in the United Kingdom, and 5.9% in New Zealand, and it has not been accompanied by strong wages growth, as is the case in the United States and the United Kingdom, Dr. Lowe said. There are important differences. A lower rate of inflation and low wages growth are key reasons we don't need to move in lockstep with others. As such, he repeated, the board is prepared to be patient as it monitors the evolution of various factors affecting inflation in Australia. And the RBA is also keenly observing the rate of employment. Full employment, which is one of the central bank's legislated mandates, is within sight, he said. It has predicted that the unemployment rate will decline to around 4% earlier than previously expected before continuing to further wind down. The central forecast is that unemployment will drop to around 3.75% by the end of the year and that it will be sustained through 2023. Dr. Lowe noted the share of working-age Australians with a job has never been higher than it is now. Australia has not experienced unemployment rates this low in the past half-century. The last time we had the unemployment rate below 4% was in the early 1970s, he stated. The RBA has chosen to take its time in raising the rate as it ventures towards full employment, which lines up its goal to achieve its inflation target. We don't want to see inflation too low or too high. We will do what is necessary to maintain low and stable inflation, which is important not only in its own right, but also as a precondition for a sustained period of full employment, he said. Many have speculated that a cash rate rise will hit before the end of the year. CBA and Westpac have both predicted an initial lift will take off in August, while ANZ has predicted the RBA will bump the rate up in September. And responding to questions from the Australian Financial Review, Dr. Lowe said he struggled to understand why investors are expecting the same number of rate hikes in Australia this year as the United States, where headline inflation at 7% was running at double the local rate. And the US Federal Reserve last week announced that it would end its bond buying program and look to begin raising interest rates from March. And the Bank of Canada, Sweden's Riksbank, the Bank of England and the Reserve Bank of New Zealand all ended their programs, and the Bank of England and the Reserve Bank of New Zealand have also started lifting interest rates. But Dr. Lowe said Australia was different to its global peers, and the RBA's decision on Tuesday to end its $350 billion bond buying program from February the 10th did not mean a rate rise was imminent. While inflation has picked up in Australia, it remains substantially lower than the 7% in the US, the 5.4% in the United Kingdom, and the 5.9% in New Zealand, and it has not been accompanied by strong wages growth, as is the case in the US and the UK, he said. Headline inflation in Australia lifted to 3.5% in the December quarter, and underlying inflation moved higher to 2.6%. Dr. Lowe said that the bank was not too worried about a massive inflation outbreak locally, which meant the bank was prepared to sit for a while, even with price growth set to run above the RBA's 2 to 3% target band. Echoing Prime Minister Scott Morrison, the Governor said Australia was within reach of a historic milestone of a jobless rate below 4% for the first time since the early 1970s, and the bank was prepared to be patient. Low unemployment brings with it very real economic and social benefits for many Australians and for the communities in which we all live. These benefits shouldn't be underestimated, he said. If we are wrong and inflation does pick up and doesn't come down, then we will have to increase interest rates more quickly than I currently think is possible. And I think, though this remains to be tested, when interest rates go up, the household sector will be quite responsive. The RBA expects unemployment below 4% later this year and 3.75% in 2023, and that will drive wages higher and faster than previously expected, and forecast wage growth to hit 3% in 2023. But Dr. Lowe also downplayed a previous strong focus on wage growth at 3% plus as a key determinant of inflation being sustainably within the target band, suggesting instead that there was no specific benchmark, but that a range of factors would be considered. The RBA Governor said Australia's inert wage settings process caused by multi-year enterprise agreements and public service wage caps, whilst leading to slower wages growth, also meant the bank had more time to consider the effects of pandemic-related disruptions on the economy. We'll also be looking for further evidence labour costs are growing at a rate consistent with inflation being sustained within the target range, and we expect this evidence to emerge over time, but is unlikely to do so quickly. The board is prepared to be patient as it monitors the evolution of the various factors affecting inflation in Australia. And he added, however, a desire to make clear the bank did not want to see inflation too low or too high, and would do what is necessary to maintain low and stable inflation. What is important, not only in its own right, but also as a precondition for a sustained period of full employment, he said. In a note on the speech, the CBA said it was still comfortable with its view the RBA will increase interest rates in August, and Head of Australian Economics Gareth Aird said on Wednesday that the speech was a case in point of the dovish tone the central bank had adopted on the inflation and cash rate outlook. But based on the RBA's updated forecast, one could easily conclude that the RBA is on the cusp of normalising the cash rate. Annual increases in living costs range between 2.6% for employee households and 3.4% for age pensioner households in the December quarter, according to the latest data from the ABS. The ABS said automotive fuel prices have increased over 30% over the past 12 months and continue to be the largest contributor to higher living costs for Australian households. The living cost indices shows the impact of changes in prices on the living costs of different groups of households: employee, age pensioner, government transfer recipient, self-funded retiree, and pensioner and beneficiaries. The impact of price changes on household living costs can vary between household groups due to the different spending patterns of those households. Food makes up a higher proportion of overall expenditure for age pensioner households compared to other types of households. Age pensioner households also experience the highest annual increase for housing costs, with relatively high expenditure levels on maintenance and repairs and property rates. Consequently, this household group has the highest annual living cost increase of 3.4%, the ABS said. Mortgage interest charges fell 1.6% in the December quarter and 7.4% over the past 12 months. Lower mortgage interest charges continue to ease living costs for households with a mortgage. This means that employee households had the lowest annual increase at 2.6%, as mortgages are a higher proportion of their overall expenditure, the ABS said. And in the December 21 quarter, prices rose for automotive fuel up 6.6%, domestic holiday travel and accommodation up 4.8%, and tobacco up 2.1%. Transport was the main contributor to all 5 population subgroups. The automotive fuel series reached record levels in the December 21 quarter due to higher global oil prices amid economic recovery and limited oil supplies. Recreation and culture was the main contributor for 3 of the 5 population subgroups: employee, age pensioner, and self-funded retiree households. This is due to price increases for domestic holiday travel and accommodation following the reopening of state and territory borders and the commencement of the peak summer holiday period. Alcohol and tobacco was a main contributor for 2 of the 5 population subgroups: pensioner and beneficiary, and other government transfer recipient households. This was due to increase in tobacco prices driven by the on-flow effect of the average weekly ordinary time earnings excise increase of 1.4%, which was applied on the 1st of September 21. And over the past 12 months, all the indices rose by between 2.6 and 3.4%. And over that longer period, transport again was the main contributor to all 5 population subgroups, with the price of automotive fuel rising 32%. The age pensioner household subgroup had the highest annual increase at 3.4%. Food makes up a higher proportion of this subgroup compared to the others. This household group has also had the highest annual increase in housing costs. The employee household subgroup had the lowest annual increases at 2.6% due to mortgage interest charges falling over the year. Excluding mortgage interest charges, that household group would have risen 3.1%. And finally, Prime Minister Scott Morrison has acknowledged that it is terribly hard for people to own their own home as house prices continue to hit new records. During an address to the National Press Club this week, Prime Minister Scott Morrison noted that it was increasingly difficult to purchase a home given escalating house prices. Indeed, the latest figures from CoreLogic showed house prices continue to soar in January 2022, making the highest annual increase since June 1989 of 22.4%. While Morrison flagged that the government had put in place a range of measures to support home ownership, he conceded that it was even harder nowadays. Over 300,000 Australians have been directly assisted into home ownership during the past 3 years through government programs like Home Builder and the Home Guarantee Scheme, Morrison said. And he later said on average Australians were also now 47 months ahead on their mortgage repayments compared to 30 months in September 2019, with an estimated $245 billion in additional savings on household balance sheets since the pandemic began. Australians have been very wise with their money during this pandemic. Very wise, he said. He said that the great Australian aspiration continues to include living the life Australians choose for themselves and to make their own way, as well as to own their own home, raise and educate their kids the way they want to do it, to be able to save for their retirement, not get into too much debt and take that occasional family holiday. But when asked by journalists how he would combat the growing housing affordability issues, Morrison said, "Home ownership has always been a challenge. On home ownership, it's always hard to buy your first home. It's terribly hard, and particularly in the city, in Sydney. I remember it, Jan and I remember it ourselves. It's hard and it's still hard, and I'd argue even harder. And that's why at the last election we came up with, I think, some very effective programs. We can't manage what happens to house prices, but we can help people get into homes. And our government has helped 300,000 Australians to get into homes," he said. The Prime Minister suggested that government should keep pursuing policies to ensure Australians could purchase properties. There'll be more to help people get their first start into their home, to ensure that Australians can continue to get a go, Morrison said. Together with the government, Australians are going to continue to exercise responsible judgment about our finances, invest in the things that help grow our economy. If you lose control of the financial and economic management levers, then Australia's worst fears on the economy will be realised. Now, the 3 points. The first is, who is responsible for the significant rise in home prices? The short answer is too much debt, which means that interest rates were too low, lending policy was too loose, and as a result, house prices have gone through the roof. So now the Reserve Bank, APRA and the government are all saying house prices are nothing to do with us. That's absolute rubbish. It's a policy choice that they've made, and we are reaping the whirlwind now. Secondly, with regard to the current costs of living, they are absolutely being understated, as I discussed previously, not least because the true costs are being masked. And therefore, we know that the real costs of living for many people are much higher. And this point about everyone's ahead with their mortgage repayments is absolute rubbish. There are some that are well ahead, but averages mask. And again, we know around 30 to 40% of households have no prepayments on their mortgage, are right up against it. There are others that are very comfortable, thank you. So again, averages mask. And the final point with regard to the Reserve Bank is they will be forced to raise interest rates much, much quicker than they are suggesting. They are trying to go through a foot shuffle to bring them closer to the reality that they've been living in for some time. That reality, of course, was a false narrative that rates will ultimately be low. And this, of course, is all about trying to protect the economy by getting more people to borrow even more. Remember that the average mortgage is 15% bigger than it was this time last year. Remember that many people are leveraged to the hilt, and they're now looking for more cannon fodder. In other words, more first-time buyers to come in and try and prop up the Ponzi scheme. So I'm afraid that this narrative is really falling apart. And the truth of the matter is that the government is responsible for higher home prices, assisted ably by the Reserve Bank and by APRA. And unless we get some fundamental change to those policies, it's likely that prices will continue to bubble higher. But that is not good for Australia, for Australians, or indeed for our place in the world. So you need to understand that behind this reckless facade is 20 years of poor policy at least, and unfortunately there is no intent from either side of politics to address the root cause issues, which is why, if you want change, you've got to find an alternative political voice. because the mainstream are not going to cut it. They will just pump things up a little more, ease interest rates back probably later when things go off the rails again, and just drive home prices ever higher. It's a ridiculous scenario that we're in, but it is a deliberately set policy, not just a happenstance. And so for Morrison to come out and say that house prices are nothing to do with him is so far from the truth as to be ridiculous. Of course, he is very strongly aligned to the property sector, so doesn't want to take the hard decisions that need to be taken. And Treasury doesn't want to take the hard decisions that need to be taken. Neither does the Reserve Bank, neither do APRA. And the reason? Well, of course, the interests of the big banks and the fact that they make most of their money from mortgage lending is what's driving a lot of this. So you have to get to some of those root cause issues and understand why people are behaving the way they are before we can make more appropriate change. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, price discovery and price transparency are hard to find, and then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.